Good morning, everybody, and welcome. My name is Patrick Shepard. I'm the Director of Member Services and Engagement for the Greater Sandusky Partnership, and it's my pleasure to welcome you to this GSP member webinar. And our topic today is employee ownership via ESOPs, a tax-savvy succession strategy. We at GSP are a regional chamber dedicated to providing comprehensive economic development services to improve the quality of life and vibrancy of the Greater Sandusky Bay region. I want to note that we are recording this webinar for on-demand viewing for other GSP members who are unable to join us today. Before we dive into the program, I want to encourage you to keep an eye on our GSP events calendar and follow GSP on social media to stay informed about our programming and our member experience events. Our next GSP member orientation is scheduled for Tuesday, April 28th at 9:30 a.m. at the Sandusky Library. You can go to our website at greatersandusky.com and register for that when you find our events calendar. I'll also put the link in the chat here shortly. I'll note that our 2026 Party at the Pier free summer concert schedule will be released later this week. And we're also going to be unveiling the Sandusky Farmers Market schedule as well. But at this point, let's dive into the topic for today. I want to introduce Greg Daugherty, a partner at the law firm of Porter Wright. Greg regularly assists business owners with their succession plans, particularly to their employees, through the formation of employee stock ownership plans, employee owner trusts, and other equity compensation arrangements. He represents publicly traded and privately held companies, tax-exempt organizations, and boards of directors, compensation committees, and management teams for these entities. Take it away, Greg, and thank you.
Thanks, Patrick. Yep. So we've got a good panel today. As Patrick mentioned, I'm an attorney at the Porter Wright law firm who works with ESOPs, and then I'll let our other panelists introduce themselves real quick. But we got Joe Borowski from GBQ, who's got a valuation background, who works with ESOP companies and trustees, and then we've got a couple of people who've gone through the ESOP or who work at ESOP-owned companies who can give you the business owner perspective. So, Joe, I'll turn it over to you to introduce yourself.
Yeah, real quick. Thanks, Greg. Joe Borowski, partner in the ESOP practice at GBQ. We work with about 115, 120 ESOP companies on an annual basis where we do their valuation work, also help trustees negotiate transactions among those companies. And then we also help companies form ESOPs by quarterbacking transactions, educating business owners on whether an ESOP is a good fit or not for their company, and then help execute that transaction that addresses all of the seller goals and works for the company as well as the employees as well. So very passionate about ESOPs. I've been doing this for about 20 years, so I've seen what ESOPs can mean for those ESOP-owned companies like Geotex, Janotta, and Herner. So excited to be talking about this today.
Thanks, Joe. And Ross and Ryan, briefly introduce yourselves.
Yeah, I'm Ross Miller, President, CFO of Geotex Construction Services. Thank you to Patrick and Greg for having us here. And we work with Greg. He's our attorney on the ESOP side, and then Joe does our valuations every year. So I know these guys very well, and they definitely know what they're talking about.
Yeah, my name's Ryan Delozer, Vice President of Geotex. I've been with the company about 16 years. About half of that was prior to our ESOP, and then the second half year has been after our ESOP transaction and the transition through that process to where we are now. So excited to share any information we can with you guys or questions you might have. So,
thank you. And then Ben.
Hey, good morning. Ben Moncher, CPA and CFO at Janotta and Herner. We are a design build general contractor in Monroeville, but we do work all over Ohio, and we have been an ESOP for over 25 years now.
Great.
So excited to share some of the longer benefits and challenges of an ESOP once it gets to being this tenured.
Great. Thank you very much, everybody. And to everybody watching and listening, feel free to ask questions. What we're going to do generally is Joe and I are going to go through a fairly quick ESOP 101, and then we'll let the two businesses tell their stories, and then we'll have a lot of somewhat of a panel discussion Q&A, but feel free to ask any questions in the meantime. What we find a lot of times is that particularly if you're a business owner thinking about an ESOP, it's often you get greater insight talking to the actual business people who've gone through it or in the process than you can from those of us who just kind of generally explain the legal or the accounting or the valuation principles at work. You need that foundation, but actually living through it and applying it, can't quite replicate that. So with that, we'll get started, and just kind of as an introduction, why are we here? Like as a general matter, every company has to deal with a succession plan at some point, whether it wants to or not. And, the basic alternatives are you do nothing, you die with your boots on, you leave the problem to your estate. And, if you have family members who can take over the business, maybe that works. But if they're not interested, hope is not a plan. And that can leave a real mess to your heirs and to your estate. You can do a leveraged, recapitalization, doing kind of a debt finance, extraordinary dividend or something. Maybe, that's a way to get, shares to family members or, maybe to key employees, not to everybody. You can sell the company, whether it's to a strategic buyer, to private equity, or you can sell to an ESOP, to your employees. And that's the focus of this presentation. And what you'll end up learning throughout the presentation is that if it's a good fit, if an ESOP is a good fit, not only is it a succession plan, but it can also help your company grow long after you've exited the business. It can provide like a lot of advantages, and not only from a financial and tax standpoint, but from a recruitment, from an employee motivation standpoint. It can work well, really for all stakeholders in the business. And Joe, I know you've done a lot of planning, and you've probably seen a lot of this over the years. Anything else to add to that?
Yeah, it's exciting to see ESOPs kind of grow and be, they have the platform to be able to talk about them today and things. I mean, as everyone knows, there's a lot of baby boomer led generations or baby boomer led businesses out there that their, owners are thinking about what to do with their business. And at the same time, over the last handful of years, there's been a lot of M&A activity in merger and acquisition activity. And so you see strategic purchases of companies, might sell to a competitor, or you see a lot of private equity activity, private equity buying businesses. And that can work. I mean, we work with companies that they'll go that route ultimately with their business. But I think a lot of business owners out there have heard the horror stories of what happens when you turn the keys over and sell to private equity or sell to your competitor, what it might mean for your business and, what it might mean for your employees. So I think that's how these conversations often start of, someone will come to someone like you, Greg, and say, well, I'd love the idea of keeping my name on the building, rewarding my management team. Unfortunately, my management team doesn't have the big check to pay me to buy my business. So I've heard about this thing about, called ESOPs, tell me more. And, we have these conversations and we'll go through it now. And there's a lot of times where we have the conversation and it's not, the right fit or the best fit for the company. But when it works, it can work really well. And you end up with two companies like we have here on our panel.
Yeah. All right. And so with that background, why ESOPs? And a lot of the things that Joe mentioned, like from a personal standpoint, if you're the business owner, it preserves your legacy more than anything else. Like you keep your name on the building, the culture that you build up, like kind of the values that you establish, like that all remains intact. It's not like private equity where we come in and how much can we cut and keep the company going? Or it's not a strategic buyer. Well, now it's my company and we're going to make everybody kind of integrate and match our values. It's still your company's culture, your company's legacy. When you're retired and you're out in the community, a lot of people say like, man, people treat me like a hero. It's like I go to church or I go to the grocery store or I'm at the club or restaurant and everyone's congratulating me. They're happy that, I did this. A lot of people, like, they want to reward their longtime employees who help get the company to that point. So there's a personal satisfaction to it. From a financial standpoint, it's
And
nice
Greg, by the
because,
way, you're still on that first slide. I don't know if, sorry to
oh,
interrupt you. I think
oh,
there
okay.
you might want to go to the
Well,
next one here.
that's interesting. Well, yeah, I may just stop screen sharing if this doesn't work. All right. Well, I can't quite get the PowerPoint to sync with the video, so it's just kind of going from where we are. So why ESOPs? And let's see if this works. Actually, hold on.
And I'm happy to give it a college try
Yeah,
too.
why don't you give it? Yeah, if you want to give it a shot, Joe.
I think Patrick will need to give me screen share.
Or let me see if this works. Let me wait. I just came out.
Joe, I just made you a co-host, and to everyone, we will certainly share the recording and the slides.
Does that work?
You're on slide 2 now.
Okay, good. Okay. Yes, there we go. All right. So yeah, so you got the personal satisfaction. Financially, the ESOP creates a market for your shares, and so you'll end up getting an appraised fair market value for your company. And maybe Joe, you can explain a little bit how that works.
Yeah, and I guess just on the personal side first, we tell business owners it's kind of the blessing and the curse a little bit of ESOPs of, nothing has to change from a management or a leadership perspective after the sale, to your point, Greg. So that's normally a good thing, right? You go the ESOP route because you don't want the business to change. You don't want it to be, disruptive to your employees and a much different culture than what you've built. But also, if you're, looking for an ESOP to come in and bring new leadership or bring new ideas, an ESOP kind of acts as a passive owner of the business. You have a trustee, which we will get into in a little bit here. That's kind of the passive shareholder. They're not bringing new ideas, or they're not, letting you retire as a seller if you're, critical to the business. They're not replacing your business acumen and things like that. But then to Greg's point on kind of the financial side of things, I mean, first things we say, an ESOP transaction is a real transaction. It's negotiated between sellers, usually advised by folks like Greg and myself. And on the buyer side, it's that trustee who's buying on behalf of the employees. So it's a negotiated transaction, and the buyer, the ESOP trustee, will hire a valuation firm, which could be someone like us or another ESOP valuation firm out there, that'll do a valuation of the company, where they'll basically inform the trustees, say, hey, based on this fair market value standard, you're able to pay X million dollars for this business. So trustee, go negotiate, but, try not to pay any more than that. If you do pay more than that, or more than what's called fair market value, there could be issues with the Department of Labor, who have oversight of ESOP companies. We like to say it's kind of the trade-off of, you're getting all these great tax benefits, which Greg and I will go into here shortly. But the kind of the trade-off of that is you can't kind of sell your company at any price. It's got to be a negotiated price that kind of reflects what would happen, if you were to take your company to market and sell at a market price.
Yeah. And the nice thing is it's a private negotiation, because you don't have a third party coming in with people inspecting the plan or all that. So you can basically keep your financial information confidential. Like, the trustee will sign a non-disclosure agreement. And so you're not sharing key information with a competitor or with a private equity firm. So that helps a lot.
Yeah, if your perspective was, man, this is a lot of work, I didn't think I'd have to do anything for an ESOP transaction, you'll be surprised the amount of hours and the rigor that goes into it. But alternatively, we work with companies that they considered a third party sale. Maybe they talk to buyers, they got the long list of, here's the 150 due diligence items that you need to provide us for us to be willing to make an offer for your business. And then you get, and heck, maybe if you end up getting the LOI stage, it's a, knockdown, drag out negotiation. The diligence process is often a lot less painful, in an ESOP transaction, even though certainly the trustee is going to be doing their work and the valuation firm and all the parties that are acting, in the best interest of the employees.
Yep. Is it showing slide 3 on you guys?
We're still seeing slide 2.
On slide 2. Okay. Then we'll share.
The other thing is you kind of trying to get that pulled back up. One thing I'll mention too, of kind of one of the financial benefits for the sellers, one of your bullets there on that slide too was, you're selling as a seller, you're selling for a purchase price. You're often not getting that entire purchase price up front, especially if you're selling 100% interest in your company, which could be a deal breaker for some sellers. If your thought was, hey, I want to sell, turn over the keys and be done, that often doesn't happen in an ESOP transaction. But alternatively, if you're interested in being around for a while, what'll end up happening is you might get some money up front through a bank loan, but you'll also be probably financing a lot of the transaction yourself. And what that means is you're earning interest on the money you're lending to the company. So even if you say you agree with the trustee that your business might be worth, let's say 10 million, you might end up with 15 million in proceeds over time because you're financing the transaction yourself. And that's attractive to certain business owners that plan to be with the company for 10 or 12 or 15 years. In some cases, even shorter amounts of time.
Yeah, what we usually tell people is that if you're looking to maximize cash at closing right away, you're going to get more, like a sale to a third party is going to be more effective at doing that. If you're willing to get paid over a few years or several years, I'd say for most of our clients, it's probably over 5 to 7 years after closing. Then the ESOP works really well because between some of the tax benefits and then the interest on the seller financing, after that 5 to 7 years, you'll probably end up in close to the same after-tax position you would have been in had you sold to a third party and taken more cash up front. And it just depends what's up to you. If you're looking to just exit right away and retire, then selling to a third party makes sense. But if you like the idea of kind of sticking around for a while, easing your way into retirement, coaching up the next generation of management, maybe Ross and Ryan, you can speak a little bit to that, because I know, the main seller for Geotex, it was funny. I remember meeting with him and he said he could have stuck around forever, but his wife said, well, in 3 years, I'm going to Florida and you can come with me or not come with me. But the way I remember working out was after the transaction, after about a year or so, I think he kind of felt, hey, I think this next generation's ready. And maybe if anything, they're holding back because they don't want to step on my toes. And I think he ended up kind of transitioning maybe a little sooner than he thought.
Yeah, I think it was about 2.5 years. We closed in, I think, July of 17.
Yeah.
And by the end of 19, he was fully out the door with varying points of transition during that time. He wanted to make sure the next generation was ready and that folks were set up to continue the legacy that he started, but he didn't want to stick around and muddy the waters either. So,
yeah. So it's real nice because
Oh,
go ahead. Yeah.
I was just going to say, Ryan had been here prior. He had the operations side handled. Rich always handled the financial side. So that was his key replacement before he could retire, was bringing in some financial person. So I started at the beginning of 19 and I got to work with him for a year. And then, like Ryan said, he retired at the end of 19. He pushed it up because felt we were ready. And then he sat on the board for a year and then was officially out after that.
Yeah. So it's nice because, like I said, it kind of gives you as a business owner, it gives you that succession and ownership, but it still kind of lets you time your exit when you personally want to exit the business. So as we move on to the next slide, then, what is an ESOP? Won't spend too much time into this, but It's actually it's a qualified profit sharing plan governed by the same ERISA tax qualification rules that that govern 401k plans and similar arrangements like that. Because of that, because it's governed by those tax qualified plan rules, uh, it has to have broad rank and file employee participation. You can't concentrate shares in the ESOP into management at the exclusion of the rank and file. There are other management incentive plans and equity type arrangements you can give to management outside of the ESOP. But within the ESOP, you basically have kind of a broad allocation formula to make sure all the employees are participating. Usually it's based on individual compensation to plan compensation, but you can combine that with tenure sometimes. There's a vesting schedule. The most common vesting schedule I see is usually after you start, after you're hired or after the ESOP's established, the first year, you're not vested in any shares allocated to your account. And then starting in year 2, it's 20%. You vest 20% a year after that until you're fully vested after 6 years. Another common approach is you're not vested at all until the 3rd anniversary of your date of hire. And then on the 3rd anniversary, you're 100% vested. Those are kind of safe harbors under the qualified plan rules. You can have variations on that, but the point is you're not just giving away your stock to employees for nothing. Like they still have to work their way into it.
And those shares get allocated over a very long period of time too. That's the question we often get of, hey, wait a minute, is all my shares going to be owned by all my employees immediately? It's usually 20, 30 years or more. So a company like Ben's, I'm guessing, has a lot of the shares allocated at this point, which is great. As the company grows, you've probably got meaningful account balances, but it's not the kind of thing of, the ownership of the company, is given away day one.
Yeah.
By the way, Greg, I started sharing my screen.
Oh, no, that's perfect. No, that's fine. Yeah, no, that's that works. Yeah.
You're doing the heavy lifting here, so I figured.
Okay. No, appreciate it. Yeah.
Tell me when to go.
Okay. Yeah. And so now you kind of get back into like why exactly are ESOPs popular? We talked about some of the personal satisfaction reasons, but ESOPs are probably the most tax advantaged vehicles in the entire tax code. Like from the company side and from the seller side, especially. From the seller side, if you're a C corporation, when you sell to an ESOP, there's Internal Revenue Code Section 1042, which operates similar to a 1031 like-kind exchange, where you take the proceeds from the ESOP sale, and if you reinvest those proceeds into stocks and bonds of any American corporation, you defer the capital gain until you sell the stocks and bonds of that other corporation. If you hold on to those stocks and bonds through your death, you get a step up in basis and eliminate the capital gain tax altogether. If you're not a C corp, there's a decision to make whether it makes sense to revoke the S election or not. But even if you decide not to, you can be taxed on the installment method, and then there could be other tax planning opportunities as well. From the financial standpoint, Joe mentioned how you get the seller financing, and that can give you an attractive rate of return. In some ways, think about it as you've sold your business, but it's almost as if you're still getting like a dividend payment or kind of benefiting like from some of the growth of the business after the sale. So that makes it nice. Flexibility is nice. We often talk about selling 100% of the business. But if there's reasons why you would not want to do it, so like sometimes if you have multiple shareholders and they're different ages, maybe the older ones want to exit, but the younger ones want to wait, you could structure it to say, okay, we'll sell a part of it now, and then over time we'll sell more of it later. I think in general, as a rule of thumb, it's more efficient just to sell 100%. You maximize the tax benefits, but it's not to say you have to do that. And then these last items we've mentioned before too, like it's a confidential negotiation process. You don't have to share information with your competitors. The ESOP trustees want to get these transactions done, and so they tend to close, more frequently and more easily than sales to third parties. And then, as we mentioned, you preserve the legacy of your business, so it's a lot of benefits to the selling shareholders. And then when we get to the company, it's really powerful because there's some extra tax deductions that you can get as a C corporation, but most companies, after they sell to an ESOP, if they're not an S corporation already, they make an S election. And this is why the advantage is to sell 100% to an S corp, because if you're 100% owned by an ESOP, you're essentially a tax exempt entity because there's no corporate tax on S corporations. But as an S corp, you're probably, it's a pass-through entity. So as a shareholder, you have to pay income tax. And so the corporation has to distribute cash out of its profits so that you can, as a shareholder, pay your income taxes. But the ESOP, as a qualified plan, doesn't pay income taxes. It's a tax-exempt shareholder. So now that the company no longer has to make distributions to shareholders to pay taxes. The distributions
we should spend a minute on this. Sorry to cut.
Go ahead. Yeah.
I mean, this is the main. If there's a top 3 reasons why people, why sellers choose the ESOP route, this is at least, this is one of those 3, and in many cases is a main consideration because this is the only structure that allows a company to really avoid paying federal income taxes and sometimes state income taxes indefinitely. So if you think about those tax rates, 20, 30% or more, and what that means is if you make, 5 million of taxable income in any other scenario, you're writing a $2 million or so annual check to the government, but you're not as a 100% S corp ESOP. Ben, your financial background give you a chance to talk, you want to maybe address kind of how, the fact that you're saving on taxes has helped, your ESOP company, giving you a competitive advantage, allow you to, do things you maybe wouldn't be able to do if you weren't, structured as an S corp ESOP.
Yeah, absolutely. It's been substantial. I mean, especially if you think about federal income tax percentage of 26% over the last 25 years, that adds up very quickly over time. And so it's helped substantially from a cash flow perspective. Our balance sheet has gotten a lot stronger. We're substantially more liquid now that we're an ESOP. So if cash is important to the company, which I imagine it is, that's a huge positive. It also, allows for more substantial profit sharing, especially once the debt or the loan is paid back to the seller. Once there is less debt on the books, you're accumulating more profit, and then you're not paying that income tax. That just kind of snowballs the ESOP effect, if you will, to the participants. So yeah, it's a very impactful classification.
And then Ryan and Ross, on your end, having gone through a transaction a little more recently, yeah, Ben, great point, Ben, on kind of when you're not paying federal income taxes, you can pay off that seller debt quicker. Geotex guys, could you talk about how, not paying taxes is, allowed you to pay off seller notes? And then also, obviously you're a very equipment intensive business. So there's that cash flow need every year to buy equipment. The tax savings, help that to a great extent, I would think.
Yeah, so we really had to change our philosophy around equipment after the transaction. We just always repaired equipment because we would only have so much cash, so much room for taking on new debt. So it was just, okay, what can we repair? What can we buy used? The fleet was really deteriorated by the time we took over. So we had to rebuild the fleet. So with us being capital intensive, it's nothing for us to spend $2 million a year on CapEx. At a $15-20 million company, what we were at the time, that's a lot of money. So having that extra cash flow, we actually ended up refinancing in year 4. We got the sellers paid off, and then the bank took all the debt on. And right now, it's not advantageous for us to pay down that debt because it's at, I think, right below 4%. So we were able to put our cash towards the equipment, which would be coming in at a higher rate.
Real good. Yeah. Lots of opportunities there. And then these last bullets, and then even the next slide, talk about the benefits to the employees. They get a really nice retirement benefit out of it. There's a lot of studies that show that a lot of people aren't retirement ready, but if they have an ESOP, that you hear stories about receptionists and secretaries or any rank and file employee, like they'll retire with hundreds of thousands, even over $1 million between their 401k and their ESOPs if they've stuck with the company for a long time. So it's a really great benefit for them. And sometimes it takes 2 or 3 years after the transaction for it to sink in. But once the employees understand that what they get out of the ESOPs directly related to what they put into the company, then it really becomes, a motivational tool. I don't know, like Ross and Ryan and Ben, like this, you guys can probably speak a lot better to that. Maybe Ross and Ryan start because you've seen kind of the before and after, like how the employees taken to the ESOP.
Yeah, it was definitely a change of mindset for them. I mean, you think about what's an ESOP. When I first heard about it, I had never heard the term before, didn't know how it worked. They're like, oh, you'll get these shares in your account. We're thinking, okay, yeah, we'll get $5 every year. Whoop-de-doo. But you get that first statement out and you're like, oh, this is real money that is essentially free money. If you understand how your 401k works, that's your money going in and growing. Well, now you're getting essentially free money that the company is giving you. You're already coming to work. You're already putting in the equity. Now you're just getting that benefit for yourself. I like to explain it to the guys when we first rolled it out. That was definitely a transition. It's like, look, you're not working for the man anymore. Like you're working for yourself, for your own future, building that wealth up. So
Yeah, just from a number standpoint, so we tell people that on average the ESOP returns about 7% into their employee owner account. And then we also have up to 3.5% 401k matching. So right there's 10.5% that's going into retirement for them. In good years, we've been upwards of 15 and 18% between the two. So it's really paid off. We've more than doubled our share value in the past 7 years because you have to be growth oriented with this.
And Ben, as an ESOP that's now long removed from the initial transaction, do you still find that it works well as a recruiting tool or motivating your employees?
Oh yeah. Right now, to the comment earlier, about 50% of our participants have a 6-figure ESOP balance. So from a recruiting perspective, with enough data now, we're able to kind of showcase what a projected retirement income is based on their age and maybe expected retirement date, based on just 25 years worth of averages, even from a conservative standpoint. So that goes a long way. And then I would also go back to, what Geotex was saying is, having skin in the game mindset, the mindset and rowing in the same direction. That's attractive to a lot of, applicants out there right now. So as we're kind of talking about ownership of a company, it's more familiar of a term. They're grasping that much quicker, and it's appealing to them from recruiting. So yeah, we heavily market that.
Joe, I don't know if you've heard any anecdotal stories about that from your clients. I know I've heard from clients where if they're like trying to attract engineers, for example, like they may be competing against Honda, but then if they're ESOP owned, a lot of the younger generation, they don't want to just be a cog in a big machine. They like the idea that they're a part of something, and the ESOP helps with that.
No, you're absolutely right, Craig. And there is, and I'm sure Ryan, Ross, Ben, you'd agree with this. There's an education
Yeah.
component because like Ryan, you said, no one kind of comes into most people never worked for an ESOP company. Don't know necessarily what that means and doesn't mean. But we talked about, I think you mentioned at the beginning, Greg, of ESOPs. The goal is to design a win-win-win transaction where it's a win for the shareholders, a win for the company, a win for the employees. The win for the employees is the easiest to explain. I mean, it's truly an added benefit. In like you guys mentioned at Geotex, I mean, you didn't change 401k benefits or pay or anything else. This just became additive to everything they got. And so as you educate your employees on that, and then help them understand of if we do well, you stand to benefit financially. It's not just a couple owners that benefit. That can be powerful. I'll also say, kind of, this goes to, and this is somewhat anecdotal, but I think I have the numbers to back it up. ESOP companies tend to operate a little differently. When I think about because we work with non-ESOP companies too. At the beginning of the pandemic or during the pandemic, I think our ESOP companies definitely resisted reducing workforce a little differently than other companies that are PE backed or publicly owned or things like that. It's definitely a more employee centric culture at an ESOP company. That helps with hiring and firing and decisions like that as well. So it's truly a great benefit to your employees, and that you just have to educate them on that. But once they understand that, it can be powerful. And then, as you mentioned on the previous slide, Greg, it usually leads to ESOP companies outperforming other companies in terms of share price growth and things like that.
Yep.
I'd like to add, Joe, to your point about the education piece. I'll say Geotex failed in that aspect in the first couple of years, and we lost some really good employees because they didn't understand it and they didn't think it was sustainable. We really started in 2020. So we started the education piece in 2020. And by no means is this a silver bullet that is going to solve all of your recruiting headaches. But it does help. And the people who are looking ahead and looking at that retirement, that's who it means the most to. I've had a couple people, operators in the field, tell me that it was a key component to their decision coming here, even though it was a little bit less on the hour than what they could have been making. The younger generation, they're not looking 40, 50 years ahead. So that's where that education piece really becomes important with that group.
But boy, if they would, that time value of money in that ESOP, like there's none of their own money's going into this, and at the end of the day, what it could be is impactful if they can wrap their mind around it.
Yeah. Can I jump in on that as
Sure.
well?
Yeah.
Is something that's as part of that recruiting piece that's worked very well for us is we do total compensation statements. So it's all of the benefits that come together. And we use that from a recruiting standpoint and a retention standpoint. And so it's not, we're showing the hourly wages, we're showing, maybe some other profit sharings that we have and some of the stipends and what have you. But then there's also that ESOP component. So to kind of give a more well-rounded annual picture of kind of the benefits they're receiving, direct compensation. Some of them are obviously, deferred with a retirement, but it's to show that full picture. That's been very well received.
Yeah, you don't want to pay the benefit and not have them recognize the value of it, certainly.
Right. Yeah, I think it's a good point. Like employee ownership, like good ideas don't always speak for themselves. So you have to have somebody, whether it's your plan administrator or as Ben does, he puts statements together to, kind of make that feel more real to your employees. Another question we get a lot is, okay, well, wait a minute. So I've sold my business and now there's this ESOP trustee who's the shareholder, and like, well, one, how does employee ownership work? Like, are, like the inmates running the asylum, that kind of thing. And so kind of first thing is no, like the only shareholder is the trustee. The employees themselves are not actual shareholders under corporate law. The trustee of the ESOP trust is the sole shareholder. The employees are beneficiaries of the trust. So the trustee has a fiduciary duty to act, in the interest of those beneficiaries. Mostly it means they vote on a slate of directors every year, and they're in charge of managing the annual valuation. And then like any other corporation, you have a board of directors. Sometimes before the ESOP, if it's your company, maybe you don't go through the formalities of having board meetings necessarily, but afterwards, you have to have a board. But usually, as the seller, you'll have a board seat. You can have somebody else at the company and management on the board. And then usually the trustee will want one independent person who's not a family member or not subordinate to you in any way. So you have that, but then the interesting thing is that because the ESOP's a qualified retirement plan, the board can hire and fire the trustee. So you kind of have this system of checks and balances, and I would say, I think Joe and I both say our experience is that most of these trustees don't want to micromanage you because they're trustees of dozens of other ESOP-owned companies. They don't have the time to do it. They're more like a financial investor. So similar, like if you or me or any of us on the call, say, well, we want to buy stock in Apple or Walmart or, whatever. We're not running the company. We just like the management team and think they'll generate a return. That's kind of the attitude of the trustee. But again, I'll turn it over to the business people to say, okay, what is, maybe we again start with Ross and Ryan. What's the relationship you have with the trustee? And, do they interfere, or is it they provide help if you ask them for it, or how involved or not involved is your trustee?
Yeah, I mean, back when ours was started, I know that interviewing the trustee, I mean, you can go through and the board kind of interviewed. We definitely had that, maybe a more of a backyard board kind of a feel. So that was something we've had to navigate as growing our board. But yeah, that interview process and selecting the right trustee for your leadership style and what you want. Do you want them to be more hands-on? Do you want them to be more hands-off? So I think you're able to go through and look and interview and get someone that complements your leadership style. And do you want them as more of an advisor? Or do you want them more of a, like you said, that hands-off piece? So
ours has really been hands-off, but we do have a good relationship with them. So there's a trust factor there. Whenever something major comes up, call them, talk it through them. Like Ryan said, they're advisors for us. If we're having, we just kind of update them mid-year. Hey, we're having a good year. We're probably going to hit our projections. This year, we're going to be off of our projections. So just having open communication definitely helps with them. And also having a good board. They put their trust in the board, especially the outside members. That's who they're relying on to keep an eye, make sure everything is going well within the company.
And you guys, and you could speak to, I think a lot of companies out there that are family owned, their board, if they have one, is consists of the shareholders or the family, or it consists of basically the management team. One great benefit we see with a lot of ESOP companies of when you're kind of asked to add external board members, they add a lot of value. And you guys have certainly, run full steam into that with kind of, the types of people you have on your board that are kind of additive from a leadership standpoint, mentors for your management team and things like that. Is that safe to say?
Yeah, definitely. And I'd say when we originally went ESOP, the owner's attitude was, I don't want somebody coming in and telling me what to do. So there was one external board member, more just a rubber stamp. When Ryan and I took over, we're young, where there's a lot we need to learn, but also we saw the need that there's so many areas that we need advice in, expertise in. Let's build our board and find those people that are experts in that area. So we have 3 outside members, 2 inside, which is Ryan and I, and 1 outside is an ESOP guru. He runs a big ESOP company. One is a growing construction company, obviously right in our wheelhouse. And then the third is a VP of human resources. So the people aspect. So those were the biggest three areas that we identified needing that expertise in. So having that outside knowledge is invaluable. Our board has been great. They push us, but then they're also there to support us. And as Joe said, we set up an agreement with each of our external board members that they have to mentor one of the executive team members. So we're getting twofold out of them.
That's great. Ben, what's the relationship with your company and its trustee and its board all these years later?
Yeah, not too different of what they just said. Our former owners sold obviously in 2000, and they continued on the management side of things for many years. And in the middle of maybe 2015 or so, at different times, but they eventually were all on the board. And so right now, half of our board is still the former owners, and then half of our board are external professionals within our area. And then from a trustee standpoint, we've had the same trustee for over a decade now. And we run through significant transactions with him. And he works closely with us through our valuation process, obviously with our stock price and what have you. But other than that, it's our trustee really just makes himself available as an advisor, not necessarily to get involved in the business.
Right. All right. So we're starting to get to the end of our slide. So here's kind of a list of factors that suggest you could be a good fit for an ESOP. You'll see a lot of these things are kind of corporate culture and the management team. And then financially, even though there's a lot of tax benefits, I think we caution that the tax benefits don't necessarily pay for themselves. If you're a struggling company, it's still a debt finance transaction. You need to have a way to pay the debt off. It's more if you are a stable company and you have a good culture, the tax benefits make a good company even better. I don't know, maybe Ryan, talk through a little bit, do you remember what Rich or your owner kind of was thinking, or what led kind of Geotex to decide they were a good fit?
Yeah, I think our biggest factor was that wanting to continue the legacy. There have been so many legacy employees, people that have been here 20 and 30 years and helped build the business. They absolutely did not want to go down the path of selling it off or liquidating. It was how can we give back to the people that helped us to get here? I mean, they went through the trenches together over 20 years. It was even so much of a piece on their hearts. They took less than what was recommended for the business just to make sure that it would be off on a good start. The valuation hey, is that worth X? We're going to take X minus some percentage just to help the company out. We don't need to run off with that kind of money. So, I mean, just the way their mentality was in that aspect and where their heart was, wanting to see the company continue what they started, and all the people that had been there with them to benefit from it.
Yeah, one of the things I remember the owner saying to me was that he had employees who had been with him for many years. And I think even in a couple cases, some of the employees who had been with him almost from day one, now their kids were starting to work into the business. Yes. And he wanted to keep that going. He liked the legacy play, and he kept saying, I want to give this company every tool available. And he also felt confident with people like Ryan who could step up, or somebody like Ross where you could bring them in and have that good leadership team. So it was real positive.
And I think that's important to drive home, and we've already talked about it. That strong management team, you've got to, if you're a seller interested in leaving anytime soon and you're critical to the business, that could be perceived as a risk by the trustee, their valuation firm. So, Geotex, I know we were in that transaction, the depth of the leadership team, the number of different individuals that had a key role, and folks like you, Ryan, that are going to be around for a very long time. That long runway, means a lot to a trustee. And to kind of harp on another bullet here, the outlook being positive. We talk to business owners sometimes and they say, well, I'm going to, grow my business to the top of the roller coaster. And then, I'm going to sell at the very, when I've maximized my profits and then, maybe the business is doing the best it ever will do. That's when I'm going to sell. And we try to correct them a little bit and say, a trustee, they're buying the company on behalf of the employees who are going to be the future owners of the business. As a buyer, you're thinking about the future and the future cash flow. So you want that outlook to be positive, like it was with Geotex, of where you can still see a path of, we've got a management team in place. There's going to be a lot of growth. That growth is what's going to pay back the debt in the transaction and things like that. So we sometimes have to counsel business owners that, you want to work with a financial advisor, legal advisor, to kind of be able to communicate that, hey, there's a lot of upside still to this business. And that's, because that's what you're buying into as a trustee.
One other thing too, before we kind of get into the next steps, for both of the companies, are there anything you would tell people thinking about an ESOP, like, hey, you're really not going to understand this until you get into it, or it would have been helpful to know in the beginning? Maybe start with you, Ben, even though, you weren't there obviously 25 years ago, but just, kind of managing the finances of this ESOP owned company. Is there anything that stands out that as a business owner, it's like, hey, be prepared for this, or, whether it's paying down debt or anything else?
A couple things. I would say, it's obvious, but the plan document is everything. So as you're establishing you're making the transaction over to become an ESOP, everything comes back to what the plan document, because again, it's an ERISA benefit plan. And so I do believe that ESOPs have figured a lot of things out, and especially, Joe and Greg, you guys have probably learned a lot about ESOPs over the last 25 years. So I think plan documents and wordings, and such as retirement ages, investing schedules, and distributions and diversification, a lot of things that go into administrating an ESOP plan has gotten a lot cleaner and better for both sides. And so that's where I would spend the bulk of my time personally, is really nailing down the plan document to make sure that it's both sustainable from a funding standpoint and sustainable from an administrative standpoint. And so that's my biggest recommendation, is just
That's a great point of, there's a lot of different decision points in setting up an ESOP, and there's a lot of customization. And I think if you're working with experienced advisors, they can point you in the right direction to make sure that this ESOP is sustainable 5, 10, 15, 20 years down the road, because those advisors have seen, what happens. Maybe they get brought into a plan where the shares were allocated too quickly, or, something wasn't kind of thought of on the front end. And it's certainly a lot harder to correct issues down the road than it is to just set things up the right way from the beginning.
Yeah. I don't know, Ross and Ryan, anything that you would tell people is, hey, like, if we would have been helpful to know this? I know you kind of mentioned the education piece as maybe one item. Anything else you'd maybe consider?
I think just from the growth aspect, our owner was nearing the end of his career. He didn't want to grow significantly. So shifting that mentality of the company from just kind of doing what came through the door every year, maybe one year we're 8 million, next year we're 12 million, then 10 million. You really need to be focused on the growth, because since this is a qualified plan, you now have that fiduciary duty to make sure that you're providing the best leadership and company outlook for the participants in the ESOP. So if you're just trying to stay stagnant and not grow, there could be a case that that's not the best fiduciary responsible thing to be doing for them. So definitely have to have a growth outlook. It doesn't have to be aggressive, but definitely working towards that growth every year.
And I would just add too that your team is important. Yeah, who you've got on your team to help you through this transaction. There's a lot of unknowns as you're doing this. I would say too, our bank was a big one for us. You might think, oh, find a bank that has a lot of experience with ESOPs. In our case, was find a bank that we have a good relationship with that has no experience with ESOPs, and hurry up to get them to sign the docs for us. So.
True. That goes to Joe's point about having a team of advisors with you. So as we wrap up, kind of if you're interested, people say, okay, well, what do I do? What's the next step? And really the answer is a feasibility study to find out, one, you do an education session like this to learn what ESOPs are, but then ultimately a feasibility study will help ask, does an ESOP work for your business? Would you get the sales price you're looking for? Can the company support the debt? Joe, I know you do a lot of feasibility studies. Maybe you can talk a little more about that.
Yeah, I know we only have a minute or here, but just to kind of quickly summarize it, the analogy we use is you'd never start, and maybe because I'm looking at a construction company right here, I'll use it. You never start building the house before you have the blueprint for the house, right? You want to know what it's going to look like before you start hammering in, putting up boards and setting the foundation and things like that. So a feasibility study is kind of designed to answer all these questions that you see here on this slide. The most important one being, usually how much would I get an ESOP premium? How much is my company worth in the context of an ESOP sale? So it's very important to kind of have these questions answered as best you can up front, because as you've probably gleaned, there's a lot of advisors that are involved in an ESOP transaction. It's an actual transaction. There's fees, legal, attorney, bank, accountants, financial advisors, things like that. You don't want to start hiring people if you're not sure the ESOP's going to address all your goals. So kind of the feasibility study is a quick, cheap way to kind of have an idea of whether an ESOP's going to work or not. Anything to add, Greg?
No, that's the whole point is you learn early on and it doesn't cost that much to do the feasibility study. And it'll tell you if it works, or maybe you need to clean up a few things over the course of the next year or two, and then you'll be ready for an ESOP. It can do that as well.
Absolutely. Yeah, the answers aren't just yes or no. An ESOP will or won't address, work for you. It might be, yes, but not quite yet. You need to, maybe clean up some, get your house in order a little bit first.
All right. So with that, I mean, these are just a list of ESOP-owned companies that Joe and I work on, throughout the state of Ohio. There's many more. I want to say, I don't know if anyone has an official record keeping, but usually I see around 300 ESOP-owned companies in Ohio. So there's a lot. Once you start thinking about it, you'll probably notice companies saying we're employee-owned. So it's pretty common. You'll see a lot of it. I think that wraps up our part. Go ahead, Joe.
I was just going to say real quick, one thing about ESOP companies and these guys, Ben, Ryan, Ross included, they're always happy to talk about what it means to be an ESOP company. So if you see a name on this list you recognize, we're happy to talk to you as folks that are heavily in the ESOP space, but we definitely encourage talking to as many ESOP-owned companies as you can, as part of your decision to maybe go this route.
Yep.
All right, everybody, we are at a little past the top of the hour. I just wanted to see if anybody from our panel has any parting words. We can open it up for questions, but I know that we had such a robust conversation that we went the full hour already, and we can certainly follow up with email with the slides and the recording and the like. But anything else from the panel before we wrap up?
I was going to say, if interested, check out the ESOP Association. They have events. Those are great introductions, meet people, have a ton of different material that they cover. So that's also a good step to looking into it.
Joe, Greg, or Ben, anything else for the good of the order?
No, nothing else.
Appreciate it, Patrick.
All right, well, thank you. Do we have any burning questions that we want to bring to the fore, or we can also, again, just follow up by email with those questions as well? All right, hearing none, then we will wrap things up. Once again, Patrick Shepard from Greater Sandusky Partnership, thank you so much to our panel. Thank you, Ben. Thank you, Ryan. Thank you, Ross. Thank you, Joe. And thank you, Greg, for this thoughtful conversation on ESOPs. Again, we will follow up with all registrants, and we'll post to our social media channels with this recording and slides and information about this topic. Thank you again and have a good day.
Thank you.